This is Kenji Sinclair. In January alone, nearly 50 million ounces of physical silver walked out of exchange vaults, 7 times the volume from 2 years earlier. That's not a rumor, that's exchange data. And it's telling you something the price chart isn't. Today, 3 things. First, the actual delivery numbers coming out of the vaults right now, and why they don't add up to a normal market. Second, why China just flipped from silver's biggest seller to its biggest hoarder, almost overnight. And third, the exact price level some of the sharpest chart readers in this space are watching, and what they're actually doing about it before it moves. Let's start with the numbers, because they're stranger than most people realize. For most of exchange history, fewer than 1 contract in 100 ever ended with someone actually taking the metal home. Traders settled in cash, rolled their position over, or just walked away. That was the rule for decades. Then it stopped being the rule. December 2025, 65 million ounces of silver delivered, a record. January 2026, nearly 50 million ounces, more than 7 times the volume from January 2 years before. Across all of 2025, total delivered silver more than doubled the prior year, and through the middle of this year, more than 170 million ounces have physically left exchange vaults. Here's the part that should stop you. That's not retail investors driving this. Nobody buying a few coins at a time moves 170 million ounces. One veteran bullion dealer, who tracks this data for a living, has floated a pointed theory that large, well-resourced players, possibly even government-linked entities, are quietly choosing to stand for physical delivery instead of settling on paper. He points to billions of dollars in gold delivered on a single futures contract, month after month, as further evidence something has structurally changed in how the biggest money wants to hold this metal. When the type of buyer changes, from paper traders to people who actually want the bars in a vault, the old rules for predicting price stop working. You're not watching speculation anymore. You're watching accumulation. It's showing up beyond the delivery window too. Retail premiums on physical coins and bars, which cratered earlier this year during a wave of panic selling, have quietly started climbing again. A sign the same buyers replacing that supply are willing to pay up for it. Point 2. And this is where it gets stranger. For years, China was silver's biggest supplier to the rest of the world, not because it mines silver directly, but because silver comes out as a byproduct of the copper, zinc, and lead mining China dominates. More than 70% of the world's silver arrives this way. And for years, China quietly exported that silver, which helped keep the global price capped under $50. Then, last autumn, during the standoff with Washington over rare earth minerals, China simply stopped. One longtime monetary analyst who's tracked this policy since the 1980s says the reversal was almost immediate. Silver ran from around $50 to $120 within weeks, and it wasn't a one-time move. In this year's first quarter alone, China's silver purchases annualize out to more than 5,000 tons, compared with the 3,000 to 5,000 tons a year it used to export. This isn't isolated to silver either. The same analyst tracks roughly 200 tons of gold flowing into China this year alone, alongside new gold trading infrastructure, vaults opening in Hong Kong and Saudi Arabia, easier rules for moving gold out of the country, even outright ownership of the London Metals Exchange. His read is blunt. China isn't hoarding metal because it expects prices to rise. It's hoarding metal because it expects currencies, including its trading partners, to fall, and it doesn't want to be caught holding paper when that happens. Even the settlement systems are changing. Prices that used to be set almost exclusively in London and New York are now being settled same day in Shanghai, Hong Kong, and the Middle East. No futures contract required, just the metal and the price in less than a day. When the world's largest industrial buyer of a metal flips from net seller to net hoarder in a matter of weeks, that's not a trading signal. That's a structural floor being built under the price, whether the chart shows it yet or not. Point 3, and this one's for anyone who wants an actual number, not just a narrative. One well-known market technician has been tracking silver's chart for years, and he keeps coming back to one level, $50. Here's why. Silver hit major highs near $50 back in 1980 and again in 2011. Both times, it got rejected hard. In chart terms, that makes $50 what he calls the scene of the crime, a level that, once broken, tends to get revisited before the market truly commits to moving higher. His current read is that silver may still work its way back down into a consolidation zone before making its next real move, but he's explicit that he doesn't try to call the exact bottom. Instead, he uses what he calls a shotgun approach, buying a little at multiple levels on the way down, rather than betting everything on one perfect entry. If silver revisits that $46 to $50 zone, he's a buyer there, scaling in gradually rather than trying to be a hero. You don't need to predict the future perfectly to act on this. You need a level, a plan for scaling in around it, and the patience to let the setup come to you instead of chasing it. And this isn't happening in isolation from gold either. The same technician has gold coiled inside its own converging pattern right now, one that has to resolve one way or the other within weeks. Silver and gold are boxed into their own versions of the same setup at the same time. Point 4 connects the technical picture to history. One independent analyst has laid this year's gold chart directly over the gold chart from 1973, and the shapes are almost identical. A double top, a sharp correction, a bottom holding almost exactly where it held 50 years earlier. Back then, once that bottom was in, gold rallied 100% in under 5 months. Overlay that same math onto today, and you get a gold target near $8,000 by the end of this year. And by his own words, in that kind of move, silver, as the more volatile, higher beta metal, should go even faster than gold does. Nobody's calling this a guarantee. Patterns rhyme, they don't repeat exactly. But it's worth noticing that this same analyst points out something counterintuitive from 1973. Gold actually fell while inflation was spiking, which is the opposite of what most people expect. If today's pullback is following that same script, the weakness isn't a warning. It's the setup before the move. History doesn't repeat, but the people who study it closely are the ones positioned before the next leg happens, not after. The same analyst also points to 2 other bubbles he thinks are already rolling over, Bitcoin and the AI-driven semiconductor trade. His argument is that as speculative capital exits those, some of it doesn't just sit in cash. Some of it rotates straight into metals, looking for somewhere real to land. Point 5 is less about a number and more about how to actually hold this position, and it comes from one of the most experienced resource investors in this space. His framework is simple. Gold is savings, silver is speculation. You don't buy gold hoping to get rich fast. You buy it so a currency losing value can't quietly rob you over time. Silver behaves completely differently, faster, more violent, and prone to parabolic spikes. And on that point, he's got a hard rule worth remembering. When he saw silver locked at its daily trading limit, rising day after day earlier this year, his experience told him to sell, not because the long-term case was wrong, but because a hyperbolic, straight-up chart is a warning sign, not a reason to celebrate. He took the proceeds and split them, half back into gold as savings, and the rest into silver mining stocks that were still priced, as if silver were half its actual value, a built-in cushion if the metal pulled back. He also flagged something silver investors often miss. A primary silver miner spending $35 to pull an ounce out of the ground is competing directly against companies pulling that same ounce out for 50 or 60 cents as a byproduct of a much bigger copper operation. That's not a small gap. In a downturn, that's the difference between a miner that survives and one that gets squeezed out entirely. And it's exactly the kind of detail that gets lost when people only look at the headline silver price. Don't treat every ounce of precious metal the same way. Know which part of your position is protecting your wealth, and which part is speculating on a move, and never mistake a parabolic chart for a safe one. So here's where that leaves us. Physical delivery data that no longer looks normal. China flipping from seller to hoarder almost overnight. A technical level with real history behind it, a historical pattern that, if it holds, points toward a much bigger move, and a simple framework for actually holding this position without getting shaken out. None of this is a guarantee. Charts break down, patterns fail, and policy can change overnight. But when 5 completely independent ways of looking at this market, delivery data, sovereign buying, technical structure, historical pattern, and portfolio logic, all point in the same direction, that's usually worth paying attention to. One more number worth sitting with. Right now, precious metals make up less than 0.5% of the average American savings and investments. The 40-year historical average is closer to 2%. That's not a wild prediction. That's just a reversion to normal. And if that allocation simply drifts back toward its historical average, demand for both silver and gold would need to roughly quadruple from where it sits today. Not because of a crisis, not because of a forecast, just because of math catching up with decades of underexposure. That's the kind of setup that doesn't need a headline to play out. It just needs time. And it's worth remembering that silver and gold are not telling separate stories right now. They're telling the same one. This is Kenji Sinclair. I'll see you in the next one.